It's April 15th, 2025, and I've got the fresh intel on what's moving the upstream oil and gas sector. Let's cut through the noise and get straight to what matters since last Friday. WTI has been dancing in the tight range of $68.20 to $69.80, settling around $69 yesterday. The EIA just reported a surprise 3.7 million barrel inventory build, and it's got traders walking on eggshells. Global demand worries and rising U.S. stockpiles are keeping a lid on prices. The futures curve has tipped into slight contango, market speak for we've got too much oil right now. Operators aren't blind to this. Several private producers are already scaling back Q3 drilling plans. The smart money's not expecting a price surge anytime soon, with most models showing WTI hovering in the $65 to $75 range through year end. Baker Hughes reported U.S. rig counts holding relatively flat since last week, down just 2 rigs to 621. On the surface, operators appear to be hanging tough despite oil prices. But I've got to admit, based on past cycles, I've lived through this, and it feels a lot like a calm before the storm. We've seen this movie before, operators maintaining activity, hopeful, while cash deteriorates, and then suddenly the dam breaks. The combination of sub-$70 oil, rising service costs, and tightening credit conditions is all the hallmarks of a squeeze coming for the U.S. upstream industry. The private operators will feel it first, but the pain won't stop there. Henry Hub's the sleeper this week. Prices jumped to about $3.43 per million BTU, up sharply since Friday. The catalyst? Hotter weather forecasts down south reported hiccups at the Freeport LNG and a storage injection that came in lighter than expected, around 52 BCF. This price action is giving producers some breathing room after a brutal stretch. Industry analysts are cautiously optimistic, with forward curves suggesting prices could stabilize in the $380 to $425 per million BTU range through 2026. Not exactly boom times, but enough to keep the lights on for efficient operators. And then Continental Resources is reportedly eyeing a $3.2 billion deal, 120,000 Bakken acres and 45,000 barrels a day of production. That's roughly $62,000 per flowing barrel, pricier than recent Permian deals, but backed by Bakken's steady output profile. Continental's doubling down on their home turf, betting the farm on better days ahead for oil prices. Wall Street's watching closely, but official confirmation is still pending. This move suggests that the consolidation wave hasn't fully crested, with quality assets still commanding premium valuations despite the challenging pace environment. The EPA's 2024 methane rules are hitting the Permian hard. Quarterly aerial surveys and continuous monitoring for larger sites. Heavyweights like Pioneer and Diamondback are looking at $18 to $22 million in compliance cost for 2025, and then $7 to $10 million annually thereafter. Smaller operators are scrambling to secure monitoring tech, and vendors are getting swamped with orders. It's another layer of pressure in a basin that's already facing geologic constraints in some areas. The regulatory burden is accelerating the advantage gap between majors and well-capitalized independents versus smaller players operating on thin margins. Despite softer oil prices, the service sector is still running hot. Halliburton and Liberty Energy just hiked pressure pumping prices 8 to 12%, citing equipment constraints and labor shortages. Frac schedules are backed up through September, with 3 to 4 week delays piling up. And on the drilling side, H&P's firing up 5 more rigs, pushing their premium fleet utilization to 94%. Day rates for top-tier rigs in the Permian and Eagle Ford are topping $30,000. This tightness isn't easing anytime soon, suggesting upstream capital efficiency may plateau in 2025 as cost inflation offsets technological improvements. Williams companies reportedly secured FERC approval for their regional energy access project. $1.2 billion to add 1.8 BCF a day of capacity from the Marcellus to the mid-Atlantic by mid-2026. If confirmed, it's the Northeast's biggest gas infrastructure win in years. Producers like EQT and Antero are already planning to ramp up drilling to fill that pipe. Local gas markets tighten just on the rumor, showing how starved the Northeast is for takeaway capacity. This development could support a more bullish natural gas price outlook, especially for Appalachian producers who've been hamstrung by infrastructure constraints. Sub $70 oil is the elephant in the room. Nobody's addressing it head on. Service costs remain elevated, while commodity prices can't support them indefinitely. Something's got to give. That flat rig count, don't be fooled. I've watched this industry through enough cycles to recognize the warning signs of a coming squeeze. The Henry Hub rally above $3 is throwing a lifeline to gas producers, and if this holds through storage season, expect capital to migrate toward gas-weighted plays like Haynesville and Appalachia. Continental's potential Bakken deals shows some players are taking the long view, banking on an eventual oil price recovery. Those methane regulations, they're hitting small operators at precisely the wrong moment, accelerating the advantage gap between majors and independents. The service sector remains tight as a roustabout's grip on a wrench, despite soft oil prices, a sign of deeper capacity constraints that won't resolve overnight. The market's sending mixed signals, but the trend is clear. 2025 is looking oversupplied, margins are compressing, and the winners will be those with scale, balance sheet strength, and operational discipline. Tech's the MVP this cycle, whether it's methane monitoring or AI-driven drilling optimization. Those who can deploy it effectively will separate from the pack. Mark Roach, FutureWise Energy, signing off.